Hi everyone, good morning. This video is scheduled on 7th of January, so very happy new year to you guys. Good. So let me just give you an introduction of what we are doing and why we are doing it. We will be discussing about the fixed income universe, and for that, in the future lectures, we will be discussing the pillars of fixed income investment. So those are actually these which are listed here, the index. So when I actually was looking at the index, it occurred to me that most of you guys might not be from finance background, and uh, you might not be able to brush up about those things because you might be a working professional, or maybe you are not applying those concepts every day. So that's why I actually went. It actually came occurred to me that I should first make some introductory videos so that you could better grasp these concepts. So that's why. And in the next readings also we will be doing in the next readings also in the next few readings. So the next reading after this, today we will be continuing with the bonds. It's just going to be an introductory session. So I will be giving you an overview of what bonds are actually are, and afterwards. So we will be discussing about the amortization schedule. I am not aware how many of you know how to make an amortization schedule on an Excel. So don't think that it's an investment advice. Don't think of uh, don't think of this. Um, just try to understand things from learning's perspective, and try to apply these concepts basically. And then we will be also discussing about tranching and securitization so that you get a better understanding of what we are going to discuss, and you would be able to relate those things. So now let's get started. So previously we have talked about the introduction of debt part, and I hope that was actually clear to you guys. Uh, it's so important, that is actually very understanding debt before you go further in the other readings. It's important. And okay, let me just, my mouse is not working. Okay, now it's working. Okay, let me just okay. So let's start with our bonds prelim. It's just an introduction. So let's start with our bonds introduction. So when we talk about bonds, let me just start with a simple question. Okay. Have you ever Have you ever lent money to a friend and expected them to return it with some extra money? So, if you have ever done that, first of all, that's actually a bad option, giving money to friends. And because, see, there are going to be informal terms, there is going to be emotional pressure, there's going to be strained relationships, risk of straining the relationship, and lack of security. So, when you give money to friends, so friends often agree on two informal terms without formal documentation, which can lead to disputes and misunderstandings. And there is also going to be an emotional pressure. Borrowing money can create emotional pressure, making it difficult to uh, manage repayments basically. And uh, money can create tension and strain in relationships, and making it hard to maintain a healthy friendship. And the risk of financial strain can lead to awkwardness and discomfort in social situations also. So, uh, don't, I would recommend you, but if you feel that you still want to give or loan money to your friend, it's your choice. So, just for just an hypothetical situation, if you ever have given money, if you have ever loaned money to a friend of yours, so let's assume that he repays you back. So that's actually what a bond actually is. That is actually it's representing a bond if you document it. So that's the simplest form, and that's what exactly a bond is also. So bond is also a loan. So when we're talking about bonds, so you have transferred money from you to your friend, and I'm assuming dollars. Uh, you can also say rupees. You can also say pounds, euros, whatever denomination you want. So that's what actually a bond is. So a bond is actually is it's a loan, and the government issues. The government is the issuer. So the government actually the issuer is the government. The government or a company borrows money, and the investor. So you are the investor who you will be lending money. If you are an institutional investor or if you are a retail investor, these are two types of investors: institutional or retail investors. So institutional investors are those investors who actually do it for institutions. So from the business perspective, and you are a retail investor, you are some finance enthusiast, and you want to make quick money in the stock market. So you will be doing, uh, or if you are aware about how the market works, uh, you are so you are doing it for personal uses, basically. So that's what retail and institution investors represent. So there is a contract between the issuer and the investor, and in return, the issuer actually promises two things. So there is going to be a regular interest payment. So there is going to be an interest payment, and he's going to return the original money also, original principal. And this is how you think. So you think of a bond as an IOU with interest. So that's basically the definition of what a bond actually is. And who actually borrows and who actually lends? So let's be very clear here. So borrower is actually the government, based most of the times, governments or companies. So if you are a retail investor, you cannot uh, issue bonds. There is a lot of rules and regulations around those. So if you want to raise money, you cannot just issue bonds. Uh, so there is going to be a borrower and there is going to be a lender. So let's assume you are the lender, and let's assume you are lending your money to the government or some company. Let's assume that you are taking Apple bonds issued by Apple company. You are taking Microsoft bonds issued by Microsoft. Let's assume Nvidia bonds. So basically, you are investing into the fixed income component of these bonds, these companies. So you are the lender, and the government or the company is the borrower, or maybe you are in government securities you are investing in. So if a government needs money to build roads or a company needs money to expand factories, they what they do is they always go to banks. Does they? Is that statement correct? And the answer to is that no. So they do not go to banks always. So they can borrow directly from people like us using bonds. And the basic bond terminology is that Uh, let's understand some common words using an example. So uh, let me just erase this first. So let's use some basic terminologies. Let's understand this thing that let's uh, just imagine a bond with a face value of $1,000. The coupon rate is 10% and the maturity is 5 years. So face value is actually the amount you get at the end of the period. So understand this from here, from this line diagram. You will be getting $1,000 at the end of 5 years, and that's the face value. The maturity is 5%, and the coupon rate is 10%. 10% coupon rate means that represent EMI. If you are familiar with the concept of EMI, so this is what coupon rate represents here. Similar to EMI, maturity is every year uh, how much multiple you are getting. So understand this thing. If the bond says it's $1,000, so how much will you receive at maturity? $1,000, correct? And the coupon rate, so this is the interest rate on the face value. And how much interest per year? Given these numbers, 10% of 1,000 is actually 100 rupees, $100. So every year you will be getting $100. $100 one, $100 two, rather than writing it. Okay, so let's write it $100. And in 5 years, you will be receiving $100. So this interest is called the coupon payment. Now understand this thing. When we talk about the maturity, so this is the date when the interest payment stops. This is the time where the interest payment will stop. So interest will stop or the EMIs will stop and the principal is actually returned back to you. The market price is the price at which the bond is trading today. If I were to check how much am I willing to pay a bond, how much am I willing to pay for a bond which is going to give me $100 every month, every year, $100 every year, paid annually. So there is a different concept also, paid annually, semi-annually, quarterly, or you can also say monthly, but uh, that's very rare. So if I'm calculating it using the annually concept, I'm considering the annual part. So I'm saying that annually you will be getting $100, and at the end of the period you will be getting $1,000, and you actually have the lock-in time for 5 years. How much are you willing to pay for that bond today? That's the market price. So this is the price at which the bond is trading today. And can this price change? Yes, every day, just like shares. This price can change. Now let's talk about yield. What does yield actually means? And yield actually means that your actual return on the bond. So if you buy a bond at a different price than $1,000, will your return be the same? And the answer to this is no. So I'm not talking about any calculation here. Just understand the concept. I will not be paying $1,000 for something which after 5 years I'll be getting $1,000 only. To understand this thing. So there is a concept also. So bond will be trading at premium. Let me just do it in a different color. Premium, par, and discount. We'll talk about this later on. So just understand this diagram first. So will you be so after 5 years, when we talk about the time value of money, understand this. After 5 years, if I'm taking $1,000 today, and I'm giving you $1,000 back after 5 years. So does it make sense? Would you be willing to pay me even after you factor in all these coupon payments and you bring them back to the present value? How much are you willing to pay for this bond today? That's what the market price of that bond is. And given on a consensus, consensus means that everyone else in the market also have somewhat similar opinions about the bond. So that's how the consensus market value is actually decided. And that's why the concept of yield actually, the concept of yield basically represents return. So return in simpler terms. So the terms which we are going to use when we talk about bonds is going to be different than the terms, the naming conventions we are going to use when we talk about other uh, financial topics, financial concepts. So I hope this much is clear. So you will not be paying the answer to the simplest answer to this is that you will not be paying $1,000 for something. So you will not be paying somebody $1,000, and at the end you will be getting $1,000 only after 5 years because of time value of money concept. So this is going to at the end of 5 years, it's not going to give you that much value as the initial $1,000. So even though you factor in, it's still not $1,000. When you are talking, when you are learning about finance, you need to think from a finance perspective. And uh, see, the thing is that not finance people, so finance people spend very wisely, and you need to spend money very wisely rather than uh, consuming it right away. Smart use of money, you should be financially literate, and that's the whole purpose of what we are doing here. So okay, let's move further in our reading. So we have not calculated the we did not calculated the current value or the market value of the bond, because that would be confusing for you, and we will do that in the future readings. But as of now, we are not talking about the calculation part. This is the overall concept part. And if you understand that, that's pretty much what I actually wanted to deliver here. So, okay, let's now move to the types of bond. And if you are curious, then it's a good thing for me. It's a positive sign for me. You should be curious, you should be confused. Then only you will start digging up why you are confused. And that's how you actually learn. That's how you actually apply. So if I teach you something and you do not uh, think about it, you do not process it inside your brain, inside your head, so you will not be able to um, apply it anywhere. So when you think about something, it starts to clear up. You start finding answers, and that's what I actually want you to. understand when we talk about this key concept series is actually about that only. Okay, so types of bonds. When we talk about the types of bonds, and so there are different types of bond. There is government bond based on issuers. There are corporate bonds if the companies are issuing those bonds. There are municipal bonds also, and there are agency bonds, government backed agencies. So who is more likely to default, a government or a small country or a small company? If you think about it, so who is going to default? So government usually do not defaults, and usually companies, when you talk about corporate bonds, so they actually have a higher risk. And that's why when you compare interest rates or coupon payments or yields, when you talk about coupon payments or yield across the bond universe, when you across these bonds, you will see that the risk varies. And that's why the coupon payment and the yield payments also, the yield interest, the yield, the yield actually also differs. And this will be totally dependent on how the market perceives about the risk. And that's why credit rating companies comes into play. And the fixed income universe is actually very much relevant for credit analysts. Okay, so now let's talk about the issuance of types of bond based on the coupon structure. So based on coupon structure, there are fixed rate bonds also. So interest never changes. Interest never changes. There are floating rate bonds also. The interest moves with the market. That's what floating means. Interest actually moves with the market. There are zero coupon bonds. This means that there is no interest. Means there is no coupon payment. Interest means coupon payment. And when we talk about the step up bonds, the step up bonds are those where the interest payment actually increases. I have limited color options here. Interest increases over time. Pardon my spellings and my language. Oh, sorry, not my handwriting. Uh, I always actually had a bad handwriting, so pardon me for that. So, which one of these actually sounds simple to you? As a beginner, and if you ask me, then I will say fixed rate bonds are actually much simpler. Because when you talk about the floating rate bonds, so here the interest actually moves with the market. MARKET, even I am not able to. It's look like some doctor has written this prescription. So so floating rate bonds actually the interest rate actually changes with the market. When you talk about the zero coupon bond rate, so there is no interest in those bonds, but the market value for these bonds will be very low. And we actually had to calculate it. We actually have to calculate before making any assumptions. It's not an assumption, but yes, usually for zero coupon bonds, the market rate, the rate at which they are trading at the market, these are basically low. And when you talk about the step up bonds, where the interest rate increases gradually, so interest rate is actually increasing with time. So there is a different concept when we talk about the step up or the step down bonds. The step up, step down bonds. So Let's not confuse ourselves right now. Okay. And there are few more classifications where the bonds are classified on the basis of maturity, where the bonds are classified based on the credit quality, and where the bonds are based on security. So secured, unsecured. This is very interesting. Based on credit quality, investment grade, high yield junk bonds, and short term, medium term, long term, perpetual bonds. Perpetual bonds are those bonds which do not have any maturity. And okay, let's discuss the issuance of bond based on time period, which is also known as maturity. So short-term bonds are those bonds which actually have a life or which are issued for less than 3 years. When we talk about the medium-term bonds, these are somewhat around 3 to 10 years, and the long-term bonds are more than 10 years. And perpetual bonds are those bonds which actually do not have any maturity. And uh, if you can Google, please Google it after you have attended this lecture, attended this episode. Disney actually had perpetual bond. So initially, when Disney actually raised money from the markets, they actually raised it through perpetual bonds. And even today, Disney is actually paying back. Actually, Disney is paying the coupon payments to those investors who actually had those perpetual bonds. And if you are able to get a hold of perpetual bond, I will recommend you to go for those. But before that, just be financially aware about things, and this is how actually you create opportunity. Not creating, but you that this is actually how you, when we talk about opportunity, this is what opportunity means. If you are able to get a hold of perpetual bond of Disney, or somebody from your family, your grandfather or your father were able to get a hold of these perpetual bonds at that time. So you would have been, I mean, you would have been old money rich, old money. You would be old money rich. And so, and if somebody did not invested in those kind of bonds, perpetual bonds of Disney, or somebody who did invested in those kind of bonds, they decided that whether or not to go with the decision based on their knowledge. So you need to brush up on your facts, brush up on your knowledge. And let's move to uh, the next type of bonds based on investment grade quality. And I need to erase I mean, erase it here first. Okay. So based on issuers we have discussed, based on coupon payments we have discussed, based on maturity we have discussed. Now we are discussing about based on the credit quality. So credit quality, if I ask you that the credit quality, if you talk about the credit quality of a bond, investment grade and high yield junk bond, these represent actually risk. When we talk about investment grade bond, I'm sure that this is an investment grade bond and the borrower is not going to default. So because the risk is low, I'm sure that my money, whatsoever I'm putting in, I will be receiving that back with interest, and everything will go smooth. Uh, so that's why these are highly rated, and that's why the highly rated by credit companies rate them highly, and that is why the yield on these bonds are actually low. And that's why investment grade bonds, when we talk about investment grade bonds, these are traded at a premium to their market value. And when we talk about high yield bonds, which are also known as junk bonds, so everything which we have discussed here, the risk, it's opposite of that. The risk is high. The risk is going to be high. Okay, I made a downward arrow here. The risk is going to be high. The credit companies are going to rate them low. They will not be highly rated. That would be the wrong, that rating them low would be the wrong term to use. The yield is going to be high. Yes, the yield is going to be high. And these will be trading at a discount to their market value. And here, just remember this, high risk means high return. Also, high risk means high return. And if you are willing to take high risk, then you will be getting high return. But the probability or the possibility when we talk about return, it's very low when it comes to high risk. If I say that I'm giving you $100 and next year, either this, I'm asking you for $100, let's say, because we are talking about lender and borrower. So I ask you for $100 and I'm saying that next year you will get $0, or maybe next month you will get $0, or maybe I will double it, $200. So what would you choose? And I'm giving you a different option. I'm saying next year it's going to be $50. Okay. I'm giving you a return of $10. So I'm saying that 100, and either I will give you $110 or I will give you $200. What would you choose? At first you will choose $200, but that is going to be a bad option. Always choose uh, safe investments. And it depends on whether you are risk averse or not. If in what if you are a young professional who has just started their career, so you can take risk, yes. If you are planning your retirement plan, how does a portfolio is actually planned? How does a portfolio is actually made for different individuals? So that's where you will learn all these things, and that's actually a part of a lots of curriculums, a lot of courses where they actually teach about finances. So the end use of finance is actually you applying it, and that's where you have actually apply it. That's one field, and there are multiple other areas also where you apply it. So I hope this much is clear. The last, the it's based on security. So there are secure bonds and the unsecured bonds, and insecure bonds are actually investment grade. Unsecured bonds are high yield, and secure bonds also have collateral when we talk about it. And unsecured bonds, no collateral. Or collateral means they have mortgages something. They have mortgaged something. They have put some asset, and here, yes, it's likely that there is some collateral, and here there is no collateral usually. Or maybe the collateral which they have pledged, or which they have mortgages, that's the value have degraded, and then the bond has actually shifted from secured to unsecured. I hope this much was clear, and we will discuss about the bond pricing in the next episode. Thank you for watching this video. Thank you for attending this episode, this lecture. And once again, a very happy new year to you guys. All right, then I will see you in the next episode. Take care.